This topic is presented by Land Investors R Us. Are you ready to file your 2020 income taxes? Like most taxpayers, there are basics you need to know, changes that took place in 2020 that you need to take into account, limitations on tax deductions and tax credits, and all these, so you do not overpay or underpay your tax liabilities. In today's topic, we are going to explain what you need to know when it comes to tax deductions most taxpayers can use when filing their income taxes. Let's start by answering the question, what is a tax deduction? A tax deduction, which must not be confused with a tax credit, is designed to lower taxpayers' taxable income, and thus, reduce taxpayers' tax liabilities. You lower your taxable income by subtracting the amount of your tax deductions from your income. The higher the amount of your tax deductions, the lower your taxable income, and the lower your tax bill. Which type of deduction should I use? Standard or itemized? To answer this question, we have to say that the standard deduction is a specific dollar amount that reduces your taxable income, and not everyone can itemize deductions. For the year 2020, the standard deduction is $12,400 for individual and married filing separately taxpayers, $24,800 for married filing jointly, and $18,650 for head of household. So, if your itemized deductions are not higher than these standard deduction amounts, you are better off using the standard deduction. Also, do not forget that there is an additional standard deduction for older and blind taxpayers. The additional standard deduction for married taxpayers 65 or over, or blind, will be $1,300, same as for 2019. For a single taxpayer or head of household who is 65 or over, or blind, the additional standard deduction for 2020 will be $1,650, same as for 2019. Now that you know what a standard deduction is, let me explain itemized deductions. One of the changes that the Tax Cuts and Jobs Act made was that it doubled the previously used standard deduction, eliminated personal exemptions, and as a result, most people are better off using the standard deduction now. We have to clarify that these changes are set to expire at the end of year 2025. Itemized deductions, also known as below-the-line deductions, or deductions from adjusted gross income, are computed on the Internal Revenue Service's Schedule A, and then the total is carried onto your 1040 form. The result of subtracting your total itemized deductions from your income is your actual taxable income. So, which deductions can be itemized? As explained before, after the TCJA was enacted, most taxpayers take advantage of high standard deductions, but still, it is recommended that taxpayers aggregate the amounts of the 6 different sections in Schedule A, to make sure they do not leave money on the table with each type of itemized deduction. For the fewer that still can itemize, these are the deductions. Section number 1. Medical and dental expenses. These are expenses that were not reimbursed to the taxpayer, or paid by others, therefore, taxpayers can itemize these expenses in Schedule A, if the total amount of these expenses exceeds 7.5% of their adjusted gross incomes. Because of this, if your adjusted gross income is $50,000, you can only deduct medical expenses beyond $3,750. Examples of medical expenses you can deduct are payments to doctors, hospital and nursing home care, insulin and prescription drugs, dentures, prescription eyeglasses, contacts and hearing aids, wheelchairs and service animals, insurance premiums for medical care, or long-term care insurance. Section number 2. Taxes paid. Taxpayers can also itemize state and local taxes. These include state and local real estate taxes, state and local personal property taxes, and state and local income taxes. For those states that do not have state income taxes in place, taxpayers can itemize general and sales taxes. Any refund received by the taxpayer from the state income taxes in the previous year must be counted as income if the taxpayer itemized deductions in the previous year. Starting in 2018, and until the end of 2025, taxpayers can deduct only $10,000 of these aggregated taxes. In addition, foreign real estate taxes, not related to a trade or business, are not tax deductible, and if you prepaid state or local income tax for next year, that amount is not deductible on your current year's taxes. Section number 3. Mortgage interest expenses. Taxpayers can deduct the interest they pay on their mortgages, and some home equity debt. Home mortgage interest is deductible, only for the first $750,000 in loans. These mortgage interests are reported by your lender every year on Form 1098 to the IRS, and to borrowers. This Form 1098 details the exact amount of deductible interest and points that they've paid over the past year. If taxpayers paid points on the homes they purchased or refinanced, they can also deduct those points paid, within certain guidelines. If the mortgage was originated before December 16, 2017, then the $1 million limitation applies. The $1 million limitation still applies if they refinance that older mortgage, as long as the loan amount stays the same. For tax years after 2025, the $1 million limitation reappears regardless of when the loan was taken out. Home equity loan or line of credit interest is deductible, provided that the borrowed funds are used to buy, build, or substantially improve the home that secures the loan. Section number 4. Charitable donations. As an incentive for Americans to give to qualified charities, that is to 501c3 public charities, donations are also deductible, within certain limitations. For cash contributions between 2018 and 2025, the amount that can be deducted is limited to no more than 60% of the taxpayer's adjusted gross income. Additional donations that exceed taxpayers' adjusted gross income must be carried over to the next year. Any cash contribution over $250 requires a written confirmation from the charity that received the donation. Other contributions can be limited to 50%, 30%, or 20% of adjusted gross income, depending on the type of property and organization receiving your donation. The Coronavirus Aid, Relief, and Economic Security CARES Act, signed into law by the President on March 27, 2020, created a new above-the-line deduction of up to $300 for charitable donations, and relaxed limits on other charitable deductions to increase charitable giving during the COVID-19 epidemic. These include cash contributions and donations of food, and they apply both to individuals and corporations. Under CARES, and for 2020 only, the 60% limitation for cash contributions is temporarily raised to 100%. Section number 5. Casualty and theft losses. Any casualty or theft loss, as defined by the IRS, and incurred as a result of a federally declared disaster, can be reported on Schedule A. Taxpayers can deduct any amount that exceeds 10% of the taxpayer's adjusted gross income, after subtracting $100 from the loss amount. If, after filing this deduction, taxpayers get anything reimbursed, they have to report this reimbursement as income in the next income tax return. Taxpayers must complete Form 4864 and report the loss on Schedule A. Section number 6. Unreimbursed job-related expenses and certain miscellaneous deductions. Prior to the passage of the TCJA, workers incurring job-related expenses were able to deduct qualified expenses that exceeded 2% of their adjusted gross income. TCJA brought substantial changes, and now taxpayers must fall into one of 4 categories to be able to claim job-related expenses. Taxpayers must be either an armed forces reservist, a qualified performing artist, a state or local government official working on a fee basis, or an employee with impairment-related work expenses. Taxpayers who fall into any of these categories can claim expenses by completing Form 2106. In addition, eligible educators may deduct up to $250 in unreimbursed expense, and can do so by completing Schedule 1. Income limitations for itemized deductions. Before the TCJA was enacted, taxpayers' adjusted gross incomes above certain levels were subject to limits on how much they could claim in itemized deductions. Those limitations, known as the PEAS limitations, got suspended for 2018 to 2025 by the TCJA. Miscellaneous deductions, what's left of them? The TCJA rules eliminated most deductions that previously fell under the category of miscellaneous itemized deductions. Many of these deductions were subject to a 2% of adjusted gross income threshold, which means taxpayers could only deduct the amount that exceeded 2% of their AGI. Under the TCJA, the 2% of adjusted gross income threshold no longer applies. As a result, taxpayers can no longer deduct the following: unreimbursed job expenses, such as work-related travel and union dues. Unreimbursed moving expenses, if you had to move in order to take a new job, with the exception of active duty military moving because of military orders. Most investment expenses, including advisory and management fees. Fees paid to prepare tax returns, except for fees to prepare Schedule C, E, or F, which are considered to be deductible business expenses. Fees to contest an IRS ruling. Hobby expenses. Personal casualty or theft losses, except when they occur in a federally designated disaster area. Taxpayers can still deduct the following though: gambling losses up to the amount of your winnings. Interest on money you borrow to buy an investment. Casualty and theft losses on income producing property. Federal estate tax on income from certain inherited items, such as IRAs, and retirement benefits. Impairment-related work expenses for people with disabilities. Interest on student loans, limited to the lesser of $2,500 or total interest you paid in the year. As we said before, the TCJA doubled the standard deduction amounts, removed personal exemptions, and also removed some deductions that could be itemized before. As a result, most taxpayers are better off using standard deductions. For the few that still can itemize, this information will help you refine your skills if you file your own taxes. And for those who still need help from a tax preparer, this information can help you communicate better with your CPA. Please leave us your comments below or email us your questions to landinvestorsforlife@gmail.com. If you like the content of this video, please consider subscribing to receive more. And thanks for watching.